Every single year, a shadow economy processes between $800 billion and $2 trillion of illicit cash. To understand the sheer size of that number, imagine taking roughly 5% of the entire world's gross domestic product and moving it across borders in plain sight. We live in an environment of constant digital surveillance, where almost every financial move leaves a trace. Yet, financial intelligence units estimate that 99% of this dirty money slips through the system without ever being caught. This shadow economy survives by functioning as a parasite, precisely mimicking the financial biology of its host to remain invisible. Criminals make their funds disappear by routing them through the exact same three stages: placement, layering, and integration that ordinary legitimate multinational corporations use to manage their wealth every day. Any large criminal enterprise inevitably runs into a serious logistical hurdle. They generate mountains of physical paper currency. It is heavy, it takes up physical space, and handing stacks of it to a bank teller instantly triggers suspicion. This leads to the first stage of the cycle, known as placement. The immediate goal is forcing that physical cash into the formal banking system without tripping the mandatory $10,000 reporting threshold. The oldest trick is smurfing. You hire a group of people, break a massive pile of cash into smaller increments like $8,000 or $9,000, and have them make staggered deposits across dozens of different bank accounts over several days. But a more efficient strategy requires buying a business that naturally deals in heavy cash volumes. Think of an all-cash parking garage, a laundromat, or a car wash. This animated chart shows how the ledger is actively manipulated. If that car wash actually earns $12,000 in legitimate revenue from real customers, the criminals take $18,000 of their illicit cash and stack it on top. The business then reports $30,000 in weekly sales, and the dirty money is mixed right in. When that single $30,000 deposit clears, the illicit funds cross the threshold. The dirty money now sits in a corporate checking account, looking exactly like routine local business profit. Now the money is digital, triggering stage 2, layering. The objective here is to sever the paper trail connecting the funds to their criminal source by rapidly moving them across international borders. This usually involves chaining together international wire transfers between shell companies, legal entities that exist only on paper to hold assets. By registering these companies in jurisdictions with minimal ownership disclosure rules, like the British Virgin Islands or Delaware, the money moves behind a curtain of almost total anonymity. Criminals also exploit modern digital tools, like cryptocurrency. While most blockchains actually keep permanent public records of every transaction, launderers bypass this transparency by using decentralized smart contracts and mixing services, also called tumblers. These programs pool cryptocurrency from multiple sources together and redistribute equivalent amounts to entirely new wallets, snapping the chain of custody. The Lazarus Group, a highly organized state-sponsored hacking syndicate, systematically utilized these digital mixing tools to wash billions of dollars in stolen cryptocurrency. Because they successfully distanced those digital funds from their origin, the money could be spent in the real world. The Lazarus Group used those laundered proceeds to directly finance North Korea's ballistic weapons programs. This brings us to the final hurdle: integration. The heavily distanced digital funds must re-enter the legitimate economy as tangible, legal assets that can be spent or displayed without raising alarms. The United States real estate market is highly vulnerable to this step. Historically, buyers haven't been required to disclose the true human owner behind a shell company, making it incredibly easy to drop millions of dollars in a single, legally sound property transaction. When federal regulators finally started tracking the beneficial owners of shell companies in certain high-value markets, the data revealed a massive blind spot. In Manhattan alone, approximately 30. The high-end art market offers a similarly useful vehicle, providing extreme buyer confidentiality and subjective pricing that makes it nearly impossible to prove if an asset's price is a genuine reflection of market value or an inflated transfer of illicit wealth. The ultimate integration maneuver closes the loop entirely. A criminal takes their freshly purchased luxury condo or painting to a major bank and uses it as collateral for a legitimate loan. The cash they receive from the bank to repay it is fully sanitized, perfectly legal, and untraceable. Executing these three stages on a global scale requires professional assistance. Bankers, lawyers, and accountants, often called professional enablers, form the infrastructure of this system, typically by choosing not to ask the questions that would expose the operation. We've seen enforcement actions validate this reality. Major financial institutions like Deutsche Bank, HSBC, and Wachovia have been caught processing hundreds of billions of dollars for cartels and illicit operations. This chart shows the discrepancy between the volume of illicit money and the consequences. Wachovia processed roughly $378 billion in unmonitored transactions tied to drug trafficking. The resulting regulatory fines represent a mere fraction of that volume. Because the banking revenue vastly outweighs the penalties, these fines are absorbed as a standard business expense rather than a true deterrent. This exposes the core dilemma for law enforcement. You cannot simply ban international wire transfers, outlaw corporate privacy, or freeze commercial real estate without crippling the foundational pillars of honest global commerce. The shadow capital system remains undefeated, allowing 99% of dirty money to keep flowing. The system works perfectly because the parasite is doing exactly what the legitimate global economy was designed to do.